Today, what we're going to do is finish up the handout. No, not that. Finish up the handout for depreciation and do textbook problems PR 9-2 and PR 9-2B, A and 2B. We'll get to that later. Anyway, so the first thing I'm going to start out with is the handout. And I just realized I did not have that up yet. There we go. Okay. So we went through the straight line method, and that's probably the most intuitive method. You know, if no one told you anything about depreciation, you probably come up with something similar to it. Oh, weird spacing here. Okay. There's another one. There's one called units of production, sometimes called units of activity. It also could be called the activity method. There's a few different terms for it, but it's all kind of this. It's the same thing. I'm going to put those up. I got to fix the spacing on this thing somehow. So units of production is called a bunch of different things. Oops. Nope. Then it's called the activity method. It's called production method. It just, you know, whatever, you kind of get the idea. I'm sure there's other ones too. So, oops. So anyway, these all mean the same thing. It's just you know, different textbooks will have the different ways, but it's all the same thing. And what it is, man, I gotta fix this weird spacing here. All right, and what it is it says, look, okay, straight line method, you take the same amount every year. That's okay if you use it the same every year, right? So if you use it about the same amount every year, you depreciate it about the same amount every year. All right, now there are some things though that you use it for a way different amount every year. The example I always use is a snow truck. You know, it's a snow plow. Some years we get tons of snow. Some years we hardly get any. So it would make sense that, and usually you get a lot of snow, you're probably gonna do a lot more snow, you know, shoveling with this truck. So it would make sense that you would expense it more. You're putting more miles on the truck, more wear and tear on the truck, all those kind of things. And you're probably also billing more for the truck. You know, if you're plowing more parking lots or whatever you're doing with the snow plow, it should match up with the expenses of that. So you probably wouldn't want to do the depreciation, the straight line depreciation, if you are running a snow truck, because it's not really, you're not using it the same every year. So that's kind of the idea behind it. Again, if you use it the same every year, straight line is fine. But if you don't, if you use it for different amounts every year, then probably units of production is a little bit better one to use. And units of production, we don't look at the life in years. We do it in some other production unit. It could be miles, it could be hours, it could be units of produced, it could be whatever it is. So it's still looking, we're still going to spread it out over its life. We're just going to do it by how much of the units it's going to create, in this case, miles. You know, we're going to get 100,000 miles out of this truck. Okay, well, how much are we going to depreciate each year? Because we're going to use it for a different number of miles each year, or you could use it. Okay, so the first thing we're going to do is we're going to find the depreciation expense per mile. Okay, so we're gonna say, okay, it's gonna last for 100,000 miles. We want to know how much each of these miles cost. So it look like this. I'm gonna put a heading on this one. Adjusting here. Okay, so kind of like before though, we're gonna start out with our cost. $32,000. We're going to subtract out our residual value. Because, why? Because we paid $32,000 for this thing, but we are going to sell it at the end of its life for $8,000. So that's going to be $8,000 coming back. So we really didn't lose $32,000. We lost $32,000 minus the $8,000. This will give us our depreciable amount. $32,000 minus $8,000 is $24,000. Yeah, it's just like the first one. Oops. Okay, so up to this point, it's exactly the same as before. Now, we have to figure out how much we're going to depreciate per mile. We think this thing's going to last for 100,000 miles. So how much is each mile going to cost us?
24 cents.
Yep. Yeah, we're going to divide it. And this time it's not by years. Be by life in miles, which is 100,000. And this will be our depreciation. Depreciation expense per mile. By the way, this is what the when you do your taxes, if you run your own business or something like that, or if you're in a company that when you guys do your taxes, this is what method they use. Is how much it is per mile. Okay, so see 24 cents. Okay, so this is our depreciation expense per mile. Okay, now there's another step here though. So here are the miles that they used the truck for. Those add up to 100,000. 80, 90, yeah, they do. Okay. Somebody didn't look like it, right? Okay, so year 2021. We use it for 100, excuse me, we use it for 10,000 miles times 24. Price per mile. And now we get our depreciation. 2,400. So that would be the depreciation for year 2021. And we'll do the same thing for 2022. 55,000. Mr. Calculator. $13,200. And we'll do the same thing for 2023. $400. So these will be the amounts that we're going to depreciate every year. I shouldn't say not every year, for each of those respective years. So I'm gonna get these over a little closer. So for year 21, we'll have depreciate by 2,400. Year 22, you'll notice we used it more than half its life. Must have had a big snowfall that year. So we're going to depreciate more, and we probably build out more for that year. And then last year, we'll about this. So what you do is you go out and you look at the odometer. So somebody will go out and look at it and see how many miles are on it. You know, the first year's got 10,000. The next year it has 65,000, right? Third year it'll have 100,000. So you just see, okay, how much did they use in that year? All right. Journal entry is exactly the same. All right, so first year it was what, 2,400? I'm sorry, there's something wrong here. I tell you guys not to do it, and I wouldn't do it myself. You usually don't put those docs in. You can, there's nothing wrong with it. But. Year two, it'd be 13,200. Question on that? Again, it's really saying, okay, how much do we actually use the thing rather than, now again, if you use it the same every year, so if you use it like say around 30,000 every year, you know, you can just use a straight line with it. Easier, quicker. But if you don't use it the same every year, it makes more sense to do it this way. It matches more appropriately the expenses with the revenues, because in this year, you probably build out a whole bunch if this is a snow plow. Whereas the first year, you probably didn't build out that much. You know, you didn't use the truck very much, you know, much less wear and tear to go 10,000 miles rather than 55,000. Okay. So let's see, the asset was 32. And that will be the same. And that'll be the same every year. Depreciation expense are these 2,400, 13,200. Okay. So it's probably, yeah, what kind of asset? It'll probably be equipment. So, I was showing you how not to spell equipment. Don't spell it that way. It's wrong. Okay. So the accumulated depreciation. Now, this is going to be the same. And the first year is going to be exactly the same. As the depreciation expense. And so you're going to, man, I wish I could do this better, these lines. Try this one, see if this one works any better. So, let's undo that. It does look interesting though. I think this is the one to go with, because this one I can go. Okay, so we're going to subtract this out. And that will equal our book value. So 32,000 minus 2,400, 29,600. Wait, I need another shape in here. Like, no. Okay. Go to the next year. Now the next year, we got to be a little bit careful because it's a different amount. So we're going to have 2,400 plus the 3,200, 13,200, 15,600. 32,000 minus 15,600. 16,400. Be 24,000. This last one will always be the depreciable amount for all of them, you know. So the book value would be the residual value. And again, these two are familiar to us. Because this is the depreciable amount. No, this is what you expect to come off the thing. Skew here. And this is the residual value. So this is what we plan on it being worth at the end of its life. By the way, you might be wondering, well, what if it isn't worth 8,000 at the end of its life? You know, what if it turns out to be worth 9,000 or 10,000 or 3,000? You know, what do you do? It depends on how far along you are. If you don't know this until the end of its life, you just make the adjustment at the end of its life. If you realize early on that, hey, this thing is going to last a lot more than 100,000 miles, say, you know, this thing's going to last for 200,000. You at that point you stop right there, and then from the going into the future, you'll work with the higher number, whatever the higher number is, or lower number if it's, you know, it's not going to last for 100,000 miles, it's only going to last for 80,000 miles. You know, whatever it is, the adjustment. So as an accountant, we do not have a crystal ball that tells us exactly how long something's going to last. You know, we might get information, you know, we might be in the past, how long have trucks lasted us, or maybe if, you know, whoever's the dealer, how long do these trucks last, that kind of thing. But we don't know exactly. You know, it's impossible to know. So, and one of the, you know, one of the things that's a little bit hard to do in accounting, because, you know, especially now you think about it like the COVID thing. Who predicted that? Basically, you know, well, I'm sure people did predict it, but hardly any really took it to heart to think this is something that could really happen. So, you know, when it did happen, all the estimates and all that, you know, they got thrown out the window because it didn't matter. So anyway, if it does work out that at some point during the thing's life you realize it needs to be changing, you stop at that point. You do not go back and redo all the financial statements going back, you know, however many years. You were working with the best information you had, that's it. So if it does end up that our estimates are off, we simply stop and go, okay, from here on, how much more do we depreciate going into the future? What period of time or how many miles or whatever it is. So whatever changes, you know, you stop at that point and say, okay, going into the future, you make the adjustment. Any question on that? But we do not go back and redo the financial statements. And that's not just true for this one, that's true for any of them. These ones up here, you know, if it doesn't last 10 years, it lasts 8 years, you know, whenever you figure that out, you stop, change over to 8 years, but you know, however many years are left, whatever. And you do not go back to, you know, 2000 or 21 and go, okay, I got to redo the financial statements because these are all wrong. You were using the best information you had. So, you know, you do not go back and change it. You simply stop and from there. Okay, why don't I be quiet? Oops. Why are you doing that? All right. Well, anyway, why don't you guys see if you can figure out number 6. My little Okay, I think you should have gotten that. 16,000, 24,000.
Yes.
Okay, good. And again, this is why you're using it, because these are different. Use them for, use them 5,000 more hours to 2022. So again, if these are all the same, you could use the straight line method. Excuse me, but if they're not, okay. So coming down here.
Sorry, can you go back to the first table? Thank you. Thanks.
Okay. Machine, I think so, probably equipment. Oops, not enough.
Could you explain where you get the 40,000 for accumulated
Yeah.
depreciation for 2022?
These two together.
Oh, okay, I got you. Thank you.
Yeah, it just keeps accumulating, and and it'll do it. Well, it doesn't say how many more miles, like or hours are left on it, but yeah, so every year you'll just keep doing it and just keep adding up. Now at the end, if your estimate is correct or close to it, the book value should equal close to the residual value of 40,000. You know, so let's keep going down. This cumulative depreciation will eventually go up to the 80,000, and then the book value will be 40,000, and you sell it. And again, you know, you don't have a crystal ball. You know, if it's close to 40,000, you just leave it. I mean, you know, if it's 38,000 or something like that, you probably just say, okay, it's not that big a deal. Question on that thing? So that is the units production method. These two methods are the ones that are mostly used in businesses. There is another, there's actually at least two more methods. They're what they call accelerated methods. There's a double declining balance, which is not used too much in companies, but it's used for taxes. And it increases the amount of that you can write off for taxes. As you guys probably, I'm sure, know that for tax purposes, you want to show, you know, in real life, you want to show that you're making a lot of income. And for taxes, you want to show that you're making very little income. And so this depreciation allows you to lower your taxes. Why do they do it? The government wants you to buy equipment. They want you to keep your business going and keep the economy going and all that. So they encourage you to buy equipment. So they say, okay, if you buy equipment, we'll let you write off a lot of it, you know, early on, which will save you taxes. And so it's kind of an encouragement thing. The tax code is not about finding your actual income. it's about encouraging you to do things and to collecting, you know, money for the government and all that kind of stuff. So their goal is not necessarily what your real income is. It's there's other stuff involved in it. But anyway, and now in business, a lot of times you hear about company and people having paper losses where they can show losses, which they like. You know, for tax purposes, losses are good, they're great, but you hear about paper losses that aren't, you know, they aren't real losses. That's what depreciation expense is. you know, for example, this depreciation expense is 24,000. This is different than, say, paying 24,000 for rent. If you pay 24,000 for rent, you're gonna write a check for 24,000, right? There's no cash involved here. So when you hear about someone having paper losses, which again, for taxes you like, a lot of it has to do with this depreciation. I owned a 3-flat in Wicker Park for a while, and you know, the first year I had it, I showed a loss of $11,000. Yes, because but it was all paper losses. It's all depreciation, and that you depreciate all the. If you have a building, you depreciate the stove, the refrigerator, the washing machines, all that kind of stuff. All gets depreciated, and so that you get those. A lot of times it's not too hard to get quite a large amount of losses in there. That's one reason why real estate is so popular for people to try to make money on it. Is that the depreciation in that is you're not paying this money out in cash. You didn't pay 16,000 out in the first year, 24,000 like you would for rent or something else. So that's one of those things that it's good to know that depreciation expense does not have to do with cash. You're not writing a check, which is different than most of your expenses. Okay, well, let's go on to, let me go ahead and save this. Any questions on this one though? Any other questions? Okay. Well, I think I sent out another one for you guys. This is problem 9-2A from the textbook. And it's good to kind of see different wording and all that kind of stuff come into play. It's good to see another problem. So what we'll do is we'll do this first one together, and then I think I'll let you guys do the other one on your own. It's a very similar one to this. But here's all the information. Now you'll notice that they gave the life in 3 years or 18,000 operating hours. All right, so these are the two. This 3 years we're going to use for the straight line method. I should have made these a little closer together. I can already tell. So this will be used for the straight line method. And this will be used for the units of production or units of activity method. So two different methods, kind of like in our inventory, we had LIFO, FIFO. You could have, you can choose which one you use. Similar in that if you use the straight line method, you're going to use 3 years. If you use the units of production or the units of activity method, you're going to use 18,000 operating hours. So, different methods will use a different life. One's in years, and this is used if it's kind of the same every year. This one is used if you use it for different amounts every year. You'll notice that when we get to this one, this all relates to the my typing skills are not very good. I'll tell you something funny. I graduated from high school in 1982. In 1982, all the high school classes, a lot of them anyways, the guys would go to shop classes for the most part, and the women would go to typing classes. me and a friend of mine went to typing classes. This is 1982. We were the first two males in the school to ever go to typing class.
Wow.
And I think if my teacher saw me the way I type now, she would just cringe, but it was the strangest thing. Anyway. All right, so let's go ahead and do it. So we're gonna do the straight line method. So this is one that uses the years. So we're gonna use 3 years. Okay, so let's see here. We have a cost. And this will be the same for both of them. The cost is $72,000. And residual value is 4,500. And so the depreciable amount is whatever that is. $65,750. By the way, another funny thing about that, I'm from Rockford, which is kind of like Detroit, you know, it's all industrial or whatever. I had taken all the shop classes because I had no intention of ever going out to college. No one, all of our, you know, all of our fathers worked in company, you know, running lathes and all kind of machine stuff. And that's what I was, you know, that was the goal back then. Kind of strange. Can't imagine it now, but. All right, so depreciable amount. So this is the depreciable amount. It's going to last for 3 years. So we're going to take this depreciable amount and life in years. It's 3. So this will equal, what number does that equal? 22,500. So this will be the depreciation expense. Oops. And this is for every year. Or per year, maybe is a better way to say it. I'm gonna do something here. I don't like the way this looks. I'm gonna add a row. Ah. Okay, so this is our depreciation expense per year. And again, straight line method, every year is exactly the same. So next 3 years, we're gonna depreciate this amount of money. We're not gonna write a check for 22,500. This is what they call a paper loss or a paper expense that you don't, there's no cash going out for 22,000. Now you did buy it, so the cash went out, you know, this is actually cash going out, but these other expenses down here are non-cash. Okay. So the asset is worth 72,000. Depreciation expense is the same every year for the straight line method, which makes it nice and easy. What was this thing? Equipment. Okay, so accumulated depreciation, the first year will be exactly the same. Book value is 49,500. Okay, next year, we're gonna have both of these for the depreciation expense that'll be accumulated. I don't know, was it 45,000? Yeah, when I graduated high school, I was gonna be a welder. I was a good welder. Didn't work out that way. Okay, so this would be 67,500.
What made you switch over to accounting or math?
There were no jobs. You know, we were like Detroit. You know, we Rockford makes all the nuts and bolts for. We were used to make all the nuts and bolts for all over the world, and those jobs just disappeared. So, you know, it literally like when I was going through, you know, high school and that, like half the parents were unemployed, just because of, you know, the economy. I mean, you know, so those jobs were just gone, and so you know, I was okay. I got to find out something. I got to find something else to do, and so I went to college. I went into business just because I was like, okay, I got to learn how to make money. So, you know, that's why I went into business and then ended up in finance and then accounting. But weird, you know, it's just one of those things. You know, it wasn't like I was born wanting to do accounting or anything. Some people are, but you know, it was not my thing.
Someone told you were going to be an accounting teacher, you probably wouldn't believe them.
I had no desire to ever teach a class. None. When I was in my master's program, I was a graduate teaching assistant, which was really great because they would pay your tuition and give you a stipend every month. So you could actually make money going to school. But one of the requirements was that you teach a class, and none of us wanted to teach a class. None of us. And I got to start teaching a class, and I kind of liked it, you know, and I ended up trading people, you know, duties to, I'll teach your class. Oh, great. You know, so anyway, after I graduated, I went into auditing for a little more than 3 years. Started teaching part-time, really liked it. And they offered me a full-time job, and that was it. It is weird though. I never in my life, and by the way, I think I told you guys this, I got C's in my first 2 accounting classes. You would not, if you saw me in my first 2 accounting classes, you would not say, that guy's gonna be teaching accounting someday. You'd say, that guy's a welder. That's what you just said. But anyway, yeah, I know it's weird. It's weird how life tastes, you know, different.
C's get degrees.
I'm sorry?
C's get degrees.
Yeah. All right, so this is what is this, 4,500, I think? And it too, though, you know, it's one of the things that's really hard about the position a lot of you guys are in is that it's very hard when you're 18, 19, 20, and someone say, what do you want to do with the rest of your life? I don't know. But anyway, it's it worked out for me anyways. Okay, so this would be the community depreciation. And the book value, so this would be the actual, this would be the like the that up. Well, this would be the depreciable amount. So at the end of the slide, the depreciable amount, and then the 4,500 would be the residual amount. You know, those are both. Those are basically what they are. And hopefully, when you sell it at the end of year 3, you know, this will be something close to what you get. Okay, there's 2 parts to these, so let's go to the next part. And that is where we do the units of production method. It starts out exactly the same as the other one. The only difference is that we use the, I did, that we're going to use these operating hours as the way that we divvy up the expenses. Okay, so it starts out exactly the same. I'm going to drop down one here just to. So the cost was 72,000. So up to this point, it's exactly the same as before. Okay, now when we divvy it up though, I would say per hour. Off the app, the operating because I'm lazy. Okay, so 67,000 by 18,000. $3.75. So this will be our depreciation expense per hour. I'm gonna drop off the operating, just put hours. We know what that is, so. Okay, so year. And so again, these are just, and we're gonna multiply that by this. Okay, so this is a little different. And again, the reason for this, you can see in here is that you use it for different amounts on different years. If they were all say the same, say around 6,000, you'd use a straight line method. But yeah, so because it's used for a different amount. And by the way, you know, if you talk about what kind of money they're gonna be making, when they used it for 7,600 hours, they probably made more stuff. They probably sold more stuff. It was probably more profitable for them. So they should have more expenses matching up with that. Okay, so let's see. This is what, 72.
Just so you know, there, you have a little decimal point instead of a comma for 76.
Oh, you're right. Yeah, that would change the answer, wouldn't it? Yeah. Okay, sorry about that. Thank you. Okay. All right, so depreciation expense. Yeah, I don't know if I can copy those down. Which I can. Hey, look at that. All right. So the first year, you know, I think I'm gonna try keeping to my old format of. Okay, so accumulated depreciation, this would be. $43,500. Okay, accumulated depreciation. So we're gonna add. Those two together. And this one would be 67,500. And the book value should be 4,500. Take this one out again. You can really see that welder part of me coming out today. All right, yeah, so this is, so the equipment minus the accumulated depreciation. Okay, I think I told you guys this before, probably want her to do it again, and that is that these two accounts are gonna go together for their entire life. These two accounts are connected. This is a contra account to the equipment. Put that in here. It'll look funny, but. So it's accumulated depreciation. This will go with the equipment account for the entire life, or whatever it is, 3 years or whatever, however long it lasts for. And when you take it, when you sell the equipment, you're going to take both those accounts off the books together. They both come off. So if you were to sell this thing at some point, the 72,000 would come off, and the 67,500 would come off at the same time. They're locked together. Question on that? Okay, well, here's your homework. Problem 9.2b, I don't know why there's a period behind B, but so this will be the homework. For, I gotta check something. Do we have class next week?
I don't think we do.
No, we don't.
Let's see. Hey, no class next week. Hey, we get my birthday off. My birthday's the 23rd of December. See? You guys think I was very important, huh? Not bad for a welder getting a birthday as a national holiday. Okay, so I guess I won't see you then. All right, this will be your job for well, let's look at the calendar. It can't be next week. December 2nd. Okay, we'll make this for December 2nd. So This is not. This is not. By the way, just so you guys know, so this will be due on December 2nd. So you'll have some time to do it, a couple weeks to do it. Okay. And just, I think some people have asked me this before in the past, and I don't think I addressed it to the whole group. We do not have a final. We will have a chapter. There's actually 2 chapters that are left. I think 7 and 8 that I combine. It's just kind of a mopping up those 2 chapters. But anyway, so the last things that we're going to have 2 tests. This is going to be the chapter 9 test that we're working on now, and then chapter 7 and 8 will be. But there will not be a comprehensive final or anything like that. It's just, you know, doing the chapters, short tests, same thing.
Thank you.
Yeah, no problem. Yeah. So anyway, yeah, there's no comprehensive final. Okay, well, I will see you guys in a long time from now. December 2nd. Okay, well, have a good break and enjoy yourself, and we'll come back in almost 2 weeks. Okay, guys, see ya. Have fun.
Professor,
great-
I had a question.
Yeah.